All right. Good afternoon, everyone. It looks like people are jumping on, but I'll go ahead and just get started with our housekeeping agenda, things like that. Welcome. This is our public service loan forgiveness review and updates for 2025. I am here today. I'm Celina Damian, the DFPI ombudsperson. I'm here with Betsy Mayotte from TISLA. This is our I'm not sure how many webinars we've had now, but this is the second to last of our series of webinars. We have one more scheduled for June 26th. All right, so we have that one coming up. But thank you for being here, everyone. We have a lot of information. Next slide, please. All right, I'm going to get started. I am with the California DFPI. We are California's Consumer Protection Agency. We regulate companies of financial products to ensure compliance, and that includes student loan servicers. So when I say regulate companies, we do license federal and private student loan servicers that service loans in California. So we do have licensing requirements and other requirements for servicers like Mohila, Advantage, Ed Financial, and Nelnet. We accept and evaluate consumer complaints against those companies, and we take enforcement and legal actions when they are not in compliance. We enforce the student loan related protections and then conduct education and outreach such as this one. Next, please. TISLA is a nonprofit agency that Betsy has been doing work with borrowers for over 20 years, and she helps thousands of borrowers across the nation. And this is the website to TISLA, the Institute of Student Loan Advisors. Next, please. So to start, just some housekeeping items. Through the entire webinar, your video, microphone, and chat feature will be disabled. You can enter questions in the Q&A. We have Katie with the DFPI and Addison with TISLA to help with those questions. Just be aware that this is a public forum. We may not be able to answer some questions if they're a little complex or just too detailed personal. You can go ahead and email us. This webinar is scheduled for an hour and a half. So I don't know if any of you noticed, it's from 12 to 1:30. We added the additional time because we know we get lots of questions and there's just a lot of information. So this event will be recorded and then it's going to be posted on our DFPI YouTube page within the next few days. And the information provided today is accurate as of today. So we know things are ever changing, but this is the information as of this date. Next, please. All right, so I do want to start off with just, as always, reminding people of their rights and their protections on the state level through Assembly Bill 376. It's the California Student Borrower Bill of Rights. And what this law does is it prohibits student loan servicers from engaging in abusive, unfair, or deceptive practices, and it requires that they work in the best financial interest of borrowers. This law is effective 2021, and it requires servicers to post and process student loan payments in a timely manner, timely process its paperwork, maintain records for a certain period of time, and then provide borrowers with information and applications for IDR plans and other forms for not just PSLF, but total permanent disability, closed school discharge, or other available forgiveness programs. And then it also requires them to respond to a borrower's qualified request or qualified written request. So if a borrower contacts their student loan servicer, they must respond within a certain amount of time. And a borrower can file a complaint with the DFPI to obtain this information. And I always tell borrowers to get everything in writing because sometimes when you're calling, we know that you are receiving inconsistent information. The information may be confusing, so it's better to get everything in writing. And then also this way we know exactly where servicers are acting unlawfully or not doing they're following these requirements. And then the Student Borrower Bill of Rights also gives borrowers the right to take legal action against their servicer if they fail to comply with these laws or if they're financially hurt or injured due to them violating one of these laws. This is called a private right of action. Next, please. And then another state level protection, which is for private student loans, the Private Student Loan Collections Reform Act. It has to do with private education lenders and loan collectors. So basically, lenders may not initiate a loan collection action unless they possess certain documents, and then a court can enter judgment in favor of the lender or loan collector unless the documents are introduced. So this is really important if you have a private loan and they're taking legal action against you. And then the Student Licensing Servicing Act and the Bill of Rights also have updated regulations effective 2024. So now they cover income share agreements and retail installment contracts. These are newer financial products. They're different than federal loans, but they're loans, contracts that are being offered for borrowers to attend other non-traditional schools. So just those are being offered by these lenders and servicers. So it's very important that you understand those protections. And then, of course, your federal protections under the Higher Education Act, and then consumer protections through the Truth in Lending Act and the Fair Credit Reporting Act. Those are also for student loan borrowers. Next, please. All right, so I've mentioned lender servicer just briefly, the difference between for federal student loans, lender servicer, your lender Department of Education for all your federal loans. So they are the ones funding, they are the bank, your student loan servicers, your Aidvantage, Mohila, Nelnet, or Aid Financial. You may have more than one servicer. You may be transferred to several servicers throughout the life of the loan. Many people ask if they can switch their servicers, and they can't just call and switch. The only time that you will be switched is when the Department of Education makes a transfers your loan, when you consolidate, and pretty much that's it. If you do go into default, which hopefully you won't get there, you will be transferred to a different servicer that handles the default loans or a default guarantee agency. But these are going to be your servicers. Next, please. And then just briefly, your federal repayment options. You have your non-income based plans and then your standard plan. These are all just based on, they're a set term plans, and they are based on your account balance. In some cases, the payment will remain the same for a term of 10 years, 20 years, and in some cases, you'll have a graduated an increase of the payment, but it's solely based on your account balance. Then you have your other bucket of your income-driven plans, which are plans that are based on your income and family size. They have nothing to do with your balance. And the reason I highlighted this is because these are going to be your PSLF eligible plans. Next, please. All right, so we are talking today about public service loan forgiveness. This program was created by Congress through a legislative process, and it was signed into law in 2007. Student under this program, student loan forgiveness is granted after satisfying certain criteria for 120 months. So to obtain PSLF, you must have the right type of loan. You must be working for a qualifying employer and be making a payment on that loan. Anytime after 2007 counts for this. So if have employment anytime after that and you meet the other criteria, you may be eligible for the program. Next, please. We're going to go into what each of these bubbles mean, or what each of these categories mean for those that are new to the program. So eligible federal loans, you must have a direct, subsidized, or unsubsidized loan. And you see all these right here, direct. After 2010, most of the loans that were dispersed to borrowers were direct loans. You have your direct subsidized or unsubsidized. The only difference between those two are the interest accrual. Direct subsidized loans, you don't start accruing interest until you start repayment. Direct unsubsidized loans, you start accruing interest from the time that the loan is dispersed. Direct and subsidized are a little bit more expensive in the long run, but those are offered to undergrad and grad students. And then your direct grad plus loans, those are eligible. And then direct plus loans made to parents and direct consolidation loans. So you can consolidate any of these loans into one direct consolidation loan, and those would be eligible. If you consolidate any of these loans and you are on the PSLF track, know that they will use a weighted average of credit towards PSLF. So let's say you have 20 payments on a direct subsidized loan, you have 15 or PSLF qualifying payments on a direct subsidized loan and 10 on a direct grad plus loan. They're going to take the weighted average and use that for your direct consolidation loan. So that's really important to note. Next slide, please. All right, so we do have the other types of student loans, federal student loans, the FFEL loans, the federal family education loans. These are going to be older loans, pre-2010 loans. These are basically commercially held loans that are backed by the Department of Education. So they're not fully direct loans. So in order for a borrower to be able to qualify for PSLF, because these loans alone do not qualify, they do have to consolidate. So any of these subsidized or unsubsidized Stafford loans, as long as they have the word "fell" in front of it, then you have to consolidate to become eligible. And then any of these other loans, nursing, Perkins, Heal, nurse faculty loans, loans for disadvantaged students, and health profession student loans. Here's the link for the consolidation, and then payments made prior to the consolidation do not count towards PSLF unless you consolidated prior to June 30th, 2024, and then you were reviewed or under the one-time IDR adjustment where they gave you credit for all your previous payments, and then they basically consolidated all your payment history, matched it up to your employment history, and at that point you were able to benefit from that. But moving forward, if you consolidate, you are not going to receive any of your previous credit. Next, please. So it's really important when you consolidate to look at your type of loans that you have and then determine if you should consolidate all of them together, if you're going to receive a weighted average, if how far along you are. So just really important to just not consolidate everything together. Really look at the loans and where you are with your current standing. And then
I'm
qualifying.
sorry, I'm just going to interject, Celina. I just want to
Yeah.
remind people if you have questions to put them in the Q&A. We are not going to be opening the microphone, so I've seen a couple of people raise their hands. And unless you were just waving at us, in which case we'll wave right back. If you raised your hand because you had a Q&A, just throw it into that Q&A panel.
Yeah, yeah, please do. We have some great people on here answering questions. So, um, now is the best time. Qualifying employment, of course, a government organization, federal, state, local, tribal. Contractors are not considered government employers. You must be directly employed by the eligible employer. There are exceptions for medical professionals in California or Texas. Any military service, if you're in the U.S. military, the Peace Corps, AmeriCorps, that counts towards your public service requirement or your employment requirement. And then any 501(c)(3) nonprofit organization. And then, so as long as their tax status is 501(c)(3), you can check that on the IRS website. You can usually check that on their website. But yeah, if I think a lot of people ask always for the government organization, it can be at any level. I mean, and it can be any position, really. So that's really important. Next, please. There are certain nonprofits that may be eligible if their primary purpose is for any of the following. So as you can see, emergency management, public safety, etc. I won't go into them, but there are certain exceptions. There is a process that you have to go through and provide certain documents, but just because you're a non 501(c)(3) doesn't mean you're ineligible. If you work for a labor union, you don't that doesn't qualify. Next, please. Believe, do I have that slide up here? Or did we take it out? Okay. All right, so qualifying employment, it has to be paid employment. So if you did internship, that doesn't count. Volunteer service does not count. You must work at least 30 hours per week, and you can be employed part-time for multiple eligible employers. Another thing, it does not have to be consecutive. So let's say you worked anytime after 2007 and you worked maybe 3 years, took some time off, came back, worked for maybe a different agency, as long as you can certify that time, and in some cases, even if you can provide W-2s, then that will count towards the qualifying employer. Parent Plus loan eligibility is based on the parent borrower's employment. So if you have a Parent Plus loan for your child and you work for the employer, the qualifying employer, then you would qualify for PSLF. The specific job performed doesn't matter. So it's not about, it doesn't have to be a certain position. It's who is your employer, who is on your W-2 form. So you could be in research, maintenance, you could be in legal, you could be in any position as long as you are employed. And then you must be working for the qualified employer at the time that you submit your last, you're at your 120 for forgiveness. Um, Next, please. And Betsy, tell me when I'm at my at my 15.
You
Um,
are. I believe this is my
this is it? Okay. All right. Well, now Betsy will take over to talk about the remaining requirements.
thanks, Selena. Um, all right, thank you, everyone. I want to reiterate some really important things that Selena pointed out. I'm really glad that she did because there are these are things that we get questions about a lot. So, I love that Selena pointed out that in order for a month to count for PSLF, you have to fit all three of those circles that she showed you at the beginning, in order for a month to count. So it has to be, you have to make an eligible payment on an eligible loan while working eligible employment. And she did a great job explaining what an eligible loan was. It's any direct loan, doesn't matter when it was made. But if you have other types of federal loans, you can't, any payments you make on, say, a Fell loan or a Perkins or the HEAL loan or any of the other loans that she listed, those can never count towards PSLF. Now, the Biden administration did put a waiver in place to allow some of those past payments to count, but going forward, we're back to old school PSLF rules. So if you do have a Fell or a Perkins or one of those other federal loans, you really need to consolidate to even just start accruing your PSLF payments. I also really like that Selena addressed some of the really common FAQs and areas of confusion for employment. She emphasized that it doesn't matter at all what you do for a living. What matters is who you work for. And she gave some really good examples of that. Um, the I want to talk a little bit more about the exception for-profit companies. So normally for-profit organizations never count. And being a contractor that happens to work for an eligible employer almost never count. But there is a fairly new exception, and California is one of the states that this applies to. If state law specifically prohibits the PSLF eligible employer from directly hiring the employees, but the employee ends up getting hired by a what would normally be considered a non-eligible employer, but they do all their work for the eligible employer, then it will count. So here's one example of how it applies in California. Apparently, California state law specifically prohibits nonprofit hospitals from directly hiring doctors. I think nurses too, but definitely doctors. So what the hospitals do is they create a for-profit arm of the hospital. And the for-profit arm does the direct hiring, but the doctor does all their actual work for the nonprofit PSLF eligible arm. Because California state law specifically prohibits the nonprofit arm from doing the hiring, that will count. Now, let me give you an example that doesn't count. I'll give you a couple. Let's say you are a contractor or you work for a private firm that does work for California state government. Now, as far as I know, there's nothing in California state law that would specifically prohibit um, the state of California from, say, hiring an IT professional. So, in that case, unless you're a direct employee of the state of California, that wouldn't count, even if you were doing all your work for the state of California, and the state of California being a government employer counts. Here's another example. So, here in Massachusetts, it's also very common for hospitals to have a nonprofit arm and a for-profit arm. But there's nothing in Massachusetts state law that specifically prohibits the nonprofit arm from directly hiring the doctors. So you could have twin scenarios. You have a doctor in Massachusetts who was hired by the for-profit arm of, say, Mass General, and they may do all their work for the nonprofit arm of Mass General, and that would not count for PSLF. But that same doctor moves to California, is hired by the for profit arm of the hospital, does all their work for the nonprofit arm, and that will count because California has something in state law that specifically prohibits the direct hiring of the doctors. Now, what the Massachusetts doctor could do would be to make it part of their contract that they're actually a direct employee of the nonprofit arm. Um, the last thing I wanted to reiterate that Celina said was if you work for an entity that is a nonprofit, but it's not a 501(c)(3), as she very correctly pointed out, those can be tricky to get approved because their primary reason for being has to be one of the bullet points you saw on the prior slide, and that's a finite list. So, let's say the entity does, um, they have a mission that's not on that list, but they happen to offer some public education. That would not count for PSLF because that entity's primary reason for being is not public education, which is on the list. It's something else that is not on the list. So, again, I just wanted to reiterate some really important things that Celina brought up because there are things that we get a lot of FAQs about. All right, so let's define our last eligible. We know what an eligible loan is. We know what eligible employment is. Let's talk about what an eligible payment is. So an eligible payment is any payment that's made on or after 10/107 that meets the other eligible payment requirements. Why 10/107? Because that's the day PSLF was written into law. The program didn't exist prior to that, so any payments you made prior to 10/107 are not going to count for PSLF under any circumstance. Um, as Celina mentioned, you don't have to make consecutive eligible payments for PSLF. These days, there really isn't anything that will wipe out your existing PSLF credits. If you consolidate, you'll get a weighted average of the existing credits, but otherwise, there's really no way to lose your existing credits. So if you work for an eligible employer for, say, 4 years, you have 4 years of credits, and then maybe you decide to become a stay-at-home parent or you go into the private sector for a minute, those 4 years of payments will still be waiting for you when you come back. Um, Now the payment does it used to be the payment also had to be made on time for it to count. That's no longer the case. If you're a couple days late or even a couple months late making the payment, it will still count as long as the loan's not in active default at the time that you make the payment. In order for the payment to count, it does actually have to be for the full amount that's due. So if your payment is $50 a month and you send in a payment for $40, it's not going to count towards PSLF. But if your payment amounts $50 a month and you send in a payment for $100, that will count and it will actually also cover the following month. You can actually send in a lump sum and have it count for a maximum of up to 12 payments. Now, before people's get excited about, oh, this is a way for me to get PSLF sooner, it's not. If you do send in extra money or send in a lump sum and are in a paid ahead status, it's still going to take you a full 10 years to get your PSLF because you can't get credit for a month until you've actually worked and certified eligible employment for that month. And you can't certify employment you haven't worked yet. You may know for a fact, you may even have a contract that says, I'm going to work for the employer of Betsy. for the next year. And you could submit that contract, but still things could happen. You could win the lottery. You could, something might happen where you might get laid off, you might become ill, or something might happen where you're not working for that employer anymore. So that's why you can never certify employment in the future. And that's why you can never get PSLF quicker than the 10 years, even if you make payments where you're showing in a paid ahead status. Now, if you were someone that benefited from the CARES pause, the COVID pause, which was from March of 2020 until the fall of 2023, those months all count towards PSLF, even though you weren't making any payments during that period. As long as would have normally been in a repayment status, so in other words, you weren't in school at the time, or you weren't in your grace period at the time, or you weren't in default at the time, and as long as you were working eligible employment and you submit proof of that eligible employment, that big old block of time was a freebie, and you do get credit for those months. And as I mentioned a couple times, there is no way to make any payment that you might make while your loan is in a default status to count towards PSLF. Now, let me clarify. Being delinquent on your federal student loan is very different from being in default. Being in default means you're at least 270 or 9 months past due on your loan, and the loan will actually show in a default status. There is no question over whether your loan is delinquent or in default. So you might get reported to the credit bureau if you're 90 days past due or more, but that's not default. So if you make those payments, they'll still count for PSLF, assuming you meet the other criteria. If you're not sure if your loan's in default or not, the best thing to do is to log into studentaid.gov, and then you'll know. There will be like a big red flag, danger Will Robertson. And I just really dated myself by using that reference, but it will tell you if your loan is in default. So again, payments made while in default don't count till PSLF. However, if you get yourself out of default, which you can do through either loan rehabilitation or consolidation, then payments that you make after the loan's out of default and back in good standing will again count for PSLF. And any PSLF eligible payments you made before you defaulted are again still going to be waiting for you once you get the loan out of default. All right, so you also need to be on a plan that's considered a qualifying repayment plan for PSLF purposes. The short answer is only plans that are based on your income, so new or old income-based repayment, pay as you earn, income contingent repayment, the SAVE plan, and I'm going to put that in quotes because the SAVE plan is dead and it's not coming back. But any payments you made while the SAVE plan was the brief moment the SAVE plan was active, that counts towards PSLF. The old repay plan, which is what SAVE morphed from, those counted towards PSLF and they're not going to be taken away. And if you're on a 10-year standard plan, excuse me, those are the plans that count for PSLF. Any of the other plans, whether if you have a consolidation loan and you're on a standard plan, that doesn't count towards PSLF because it's not a 10-year standard. It's a 12 to 30-year standard. The graduated repayment plan, extended repayment plan, as I mentioned, payments made while in default, none of those count towards PSLF. Now, if you're not sure which plan to pick, we suggest you use what's called the loan simulator tool, which you can find at studentaid.gov. Um, and that will tell you what plan will give you is PSLF eligible and also gives you the lowest payment amount. Now, if you're pursuing PSLF, you should pay the least amount that you're eligible to pay. You should not pay a penny extra. I see some people sometimes that try to sort of hedge their bets. Not sure about this old PSLF thing, so I'm going to pay an extra $100 a month or whatever towards my loans to reduce interest. Don't do that. One either pursues loan forgiveness, in which case you pay the least amount you're required to, or you pay extra to reduce total interest costs, not both. If you're not sure if you're going to ride out the whole PSLF thing and you want to hedge your bets, make the extra payment, but not to your loan. Make it to an interest-bearing account. And then if at some point you're like, yeah, no, I'm going to go into the private sector or somehow also just not be eligible for PSLF, then you take all that that savings, that's accrued interest on that you get the benefit of, and send in a lump sum payment at that point to reduce the interest. What else was I going to say about payment plans? Okay. So a little bit about the income driven plans. Now, those can be really confusing because they're all sort of exactly the same except where they're different. Um, and going over them in gory detail is a whole other 90-minute presentation. But just sort of some basic facts that the IDR plans have in common. They all base your payment off of, for most people, your adjusted gross income, off your most recent tax return. Now, if your most recent tax return does not accurately reflect your income, you can also submit pay stubs. However, with pay stubs, they tend to use gross income instead of AGI. So pay stubs, you might end up having a slightly higher payment amount than you would if your tax return accurately reflected your income. Now, if you're married and you file your taxes as married, they are going to also use your spouse's income in the income driven plan calculation. Now, I know this gets people's knickers in a twist. There's a lot of marriages where it's like, these are my loans, they're not my spouse's loans, they have no responsibility for them. That's true from a legal perspective, but the way the income driven plans work, if you file your taxes jointly, they are going to use your spouse's income. No ifs, ands, buts, or maybes. The only asterisk there is in extreme situations, usually in where there's domestic abuse and you're no longer living together, they in those cases might be able to exclude spousal income even if you file taxes jointly. So if you're pursuing PSLF, and especially if your spouse doesn't have student loans of their own, it is the common practice to suggest that you file your taxes married filing separately. Now, keep in mind, if you do that, you tend to lose out on those sweet, sweet marriage tax credits. So your tax bill could be higher. So you might want to do the math to see if it makes more sense to keep filing jointly, knowing you might have a higher student loan payment, or if it makes more sense financially to file separately, losing out on those marriage tax credits, but getting the lower student loan payment, especially if you're pursuing forgiveness. Now, but for any of you who are starting to type furiously to ask a tax question, please don't. We only have one superpower here, and that superpower is student loans. We can't answer any of your tax questions. With that said, there's a lot of great information online, and there's also some great calculators online that can give you a general idea of the difference in your tax liability, whether you file your taxes jointly or whether you file them separately. And remember that loan simulator tool I mentioned earlier, you can plug in your numbers both ways. What would my student loan payment be if we filed our taxes jointly versus if we filed our taxes separately? Um, Now, there's some other eligibility criteria to get into some of these IDR plans. For IBR, for new IBR and pay as you earn specifically, you can't have any loans that were ever made older than a certain date. For pay as you earn, you can't have any loans older than October of '07. And what you're looking at, if you're looking at your loans on studentaid.gov or your servicer's website, you're looking at the first disbursement date of the loan to see if it meets that criteria or not. If you do have loans older than October of '07, even if you've since consolidated them, you're not eligible for pay as you earn. If you have loans older than July of 2014, you're not eligible for what's called new IBR. But you should still be eligible for income contingent repayment and old IBR. Neither one of those plans have any like loan age restrictions to them. Now, all the income driven plans, so new IBR, old IBR, pays you earn, also have what we call a partial financial hardship or PFH requirement to get into the plan in the first place. And what that means is that your calculated payment under those plans has to be less than what you'd be paying if you were under a 10-year standard plan. If your income is to the point where your payment under old IBR, new IBR, pay as you earn would be the same or higher than what you would pay under a 10-year standard, then you're not going to be let into those plans in particular. ICR has no such requirement. The other thing I want to mention about PFH, excuse me for a minute, is once you're in the plan, even if your income does go way up, they're not going to kick you out. What they'll do is they'll cap your payment at whatever you would have paid under the 10-year standard. So as long as you don't actively leave the plan, they're not going to kick you out of pay as you earn, old IBR, or new IBR, even if your income increases to the point where your payment would be the same or more than a 10-year standard. Now, a really common question we get is, well, what's the best plan? And the answer is, well, that depends. It depends on how much you owe, depends on which plan you're eligible for, depends on your income. So, the best plan, and this might sound like a duh, and I don't mean it to be, but the best plan, if you're pursuing PSLF, is the plan that's eligible for PSLF that will cost you the least amount every month. Now remember, pay as you earn and new IBR, they have the same calculation. So if you're eligible for both, doesn't matter which one you pick. I would pick new IBR personally, because that one hasn't necessarily been at risk with any of the SAVE litigation, although it may be at risk with the Budget Reconciliation Act, which we're going to talk more about in a little bit. But they have the same math. So your payment under pay as you earn and new IBR will be exactly the same. ICR tends to be, for most borrowers, the highest monthly payment for the income-driven plans. The exception to that statement are borrowers whose income is high compared to what they owe. And in that case, ICR might actually be the lowest that they're eligible for. Under the income-driven plans, old IBR it tends to be the second highest payment amount. So if you're not eligible for pay as you earn a new IBR because you have older loans, and your income is not very high compared to what you owe in student loans, old IBR is probably going to be your best bet. But again, you don't have to remember any of this. You can just use that loan simulator tool to see which plan might make the most sense. Save plan / repay are no longer an option. You can't even apply for them. As I think we mentioned, Save is dead. We just don't know who's putting the headstone up yet. We don't know if it's going to be Congress or the courts. Now, if you have Parent Plus loans, here's where it gets tricky. And it's kind of mean because, as Celina mentioned, Parent Plus loans are eligible for PSLF, but it's a little bit of a trick because Parent Plus loans, in and of themselves, aren't eligible for any of the income-driven plans. And if you math it out, Parent Plus loans are eligible for the 10-year standard plan, but if you make 120 payments on a 10-year standard plan, you will have paid the loan off. So, Parent Plus loans, they can consolidate, at which point they become eligible for ICR and ICR only. Now, there's also a loophole. We used to call it the super secret double consolidation loophole for Parent Plus borrowers, which just rolls off the tongue, right? I leave off the super secret part now because it's not as much of a secret as it used to be. Double consolidation is a way where you can get a Parent Plus loan to qualify for these other 10 lower cost income driven plans like pay as you earn, the two IBRs, as well as ICR. The other qualifications still apply. You have to have a partial financial hardship. You can't have any loans older than either '07 or 2014 for those plans. But if the Parent Plus borrower themselves has income that is fairly low compared to what they owe, the double consolidation loophole might make a lot of sense. Now, there used to be a deadline of July 1st for the double consolidation loophole, but because of the SAVE litigation, and this is sort of one of the few positives about the SAVE litigation nonsense, is that deadline is currently gone. Now, let me be clear. I absolutely think a deadline is coming back. It's not going to be July 1st, but it could be, if a deadline is created through budget reconciliation, it could be August, it could be July 4th. We don't know when a new deadline is going to come up, but I am pretty certain that they are going to put a deadline on that loophole. So if double consolidation is going to benefit you, I suggest you start it today just to be on the safe side. Now, here's how double consolidation works. I'm going to go back to this other slide in a second. And if your head is spinning a little bit on this, don't worry about it. If you go to our website, freestudentloanadvice.org, and go onto the consolidation page and scroll down, we have step-by-step instructions on how to achieve the double consolidation loophole. Please follow them to a letter. to the letter. There's a method to our madness. If you don't follow them that way, there's a chance you could make a mistake, and therefore not be able to utilize the double consolidation loophole. But at the 5,000 foot level, essentially what you're trying to do is consolidate each one of your Parent Plus loans twice. So in this example you see in front of you, this borrower has four individual Parent Plus loans. And by the way, a common question we get is even if you only have two Parent Plus loans, you could still do double consolidation. If you only have one, you can't. But in this example, the borrower has four loans one, two, three, and four. Step one, they consolidate loans one and two together, and they consolidate loans three and four together. So now this borrower has two consolidation loans and no Parent Plus. They have consolidation loan one and they have consolidation loan two. The last step is they consolidate those two consolidation loans together to create consolidation three. So what we've done here is we've consolidated each one of the Parent Plus loans twice. The first consolidation was in step one, and then the second consolidation was in step two. Now, even if your income is high and you don't necessarily think that double consolidation will benefit you right now, hopefully you're going to retire at some point and you might want to preserve that double consolidation opportunity now. Again, we don't know what's going to happen with budget reconciliation. We don't know what's going to happen with any future regulatory changes. But usually, whenever they make law or regulation changes, they grandfather in people that were already doing the thing before they changed the thing. So it might be, even if you don't think you'll benefit from it now, it might be you might really want to preserve that option to have eligibility for those plans down the road by doing the double consolidation. Um, Now, I'm going to talk more about budget reconciliation in a minute, but in the meantime, I want to take a breath and check in with Addison and Katie and see if we've gotten any questions so far about anything that we've covered so far that might be good for the whole group to hear.
No, nothing for me right now.
Okay. Katie, anything you think I should cover in a little more detail or reiterate?
Nope, not right now.
Okay. All
Can
right.
I, I just want to jump in, there were a few questions about the COVID forbearance months, March 2020 through September 2023. So those were eligible months for PSLF, and then about consecutive, concurrent. So these payments do not have to be consecutive, which means you don't have to do 10 straight years or 120 straight months. So there can be gaps as long as cumulative, it's 120.
Right. Right. Thank you for those.
You're welcome.
All right, let's talk budget reconciliation. So, the current budget reconciliation process is almost certainly going to make changes to student loans. It could even make changes to existing loans. Now, historically, Congress has never removed a benefit from existing loans. Um, the current House proposal for budget reconciliation that has passed the House does make changes to existing loans and makes very significant changes to future student loans, loans made on or after whenever this darn thing gets signed into law. I'll talk a little bit about what's in that proposal in a second, but I cannot emphasize this enough. This is not by any means a done deal. The Senate, we've already heard a lot of chatter that the Senate hates the House bill. The other thing is the Senate, their spending marching orders are wildly, vastly different than the House. So, like under education, the Senate's sort of marching orders is to save, I think it's $1 billion. The House is to save 300 billion. So they're wildly apart. So I would be very, very surprised if a lot of what's in the House bill actually made it to whatever the final budget reconciliation is that gets signed into law. But the bottom line is we don't know. There's just so many moving parts here. And until we see the Senate's version of budget reconciliation for higher education, I don't even have a gut sense that I can share with you about which proposals in the House bill are going to end up having legs and which ones don't. I mean, when the Senate bill comes out, anything that's in the Senate bill that seems to closely match what's in the House bill, if you're trying to plan, I would say there's a good indication that that will end up in the final legislation. But anything that's not in the Senate bill, that's in the House bill, all bets are off. They're at negotiation phase. Now, their original deadline for completing budget reconciliation was July 4th. Nobody thinks they're going to make July 4th. Nobody. But most people do think that they will have to complete it by August when it's anticipated we're going to reach our debt ceiling. So they're going to be, under a lot of pressure to finish budget reconciliation in August. So you're not going to be in limbo for a long time, but nobody should be making any panic decisions based on this House bill. Now, what the House bill does, the reason I sort of bring it up now, because I was just talking about the double consolidation for Parent Plus loans. One of the things the House bill does is it anybody who has double consolidated a Parent Plus loan and is actively on income contingent repayment as of the date of enactment of this budget, this mythical budget reconciliation. I say mythical. We're going to get a budget reconciliation. We just, again, don't know what it looks like yet. They will be transferred into a new version of income-based repayment. But anybody who hasn't double consolidated and is not actively on ICR as of the date of enactment would not be able to utilize income-driven plans. So they basically cut off Parent Plus loans, whether double consolidated or not, for any of the income-driven plans. This is one of those proposals that if you forced me to speculate, I don't think it's going to survive the Total Reconciliation Act. But again, we don't know. And it would be irresponsible of me for me to tell you that's never going to happen because, we're in weird times now. So that's another reason that anybody who has a Parent Plus loan might want to hop to it and not dawdle about moving forward with double consolidation. So just in case that particular proposal makes it through to the final, that you will have sort of preserved your eligibility spot for income-driven repayment plans. Other things that this budget reconciliation does, as far as the House bill, I should say, as far as PSLF goes, the only changes the House bill makes to PSLF is it makes periods where people are in medical residencies not eligible for PSLF. It does give those borrowers an interest-free forbearance during residency, but it doesn't allow them to count periods of residency towards PSLF. Again, we do not know if that will make the final bill or not, but that's the only, there's a lot of people that were worried that Congress was going to get rid of PSLF. Frankly, I was never worried about Congress getting rid of PSLF because there's just no political points to be gained there. I do think that the House is trying to limit PSLF through a back door by limiting the amount of student loans people can take out in the first place, including Parent Plus loans. If this House bill were to pass as written, Parent Plus loans would be limited to 50,000, period. If you had 12 kids, you still could only ever borrow 50,000 total in Parent Plus loans. It also limits graduate school borrowing. So I think that while they wouldn't be going after PSLF specifically, they're sort of might be trying to limit forgiveness through a backdoor by limiting the amount people can borrow in the first place. The House bill also limits repayment plans, especially for new borrowers, to either a standard plan or a plan being called the Repayment Assistance Program, which is based on income and does have a 30-year forgiveness component, and that would count towards PSLF. Existing borrowers would still be able to get a newer version of income-based repayment as well. But, again, nobody, I know I'm repeating myself of doing it on purpose because I know there's a lot of anxiety around this. Nobody should be making any snap decisions about their existing student loans other than potentially double consolidating if you have a Parent Plus loan based on the existing House bill. At least wait and see what we get with the Senate version of the bill. Okay, so all of that aside, so how do you get started actually pursuing PSLF? Now, listen, technically, you're not required to certify your PSLF employment until you hit 120 payments. That is a terrible strategy. That's recipe for disaster. Um, while you're not required to, we strongly recommend that you get in the habit of certifying your employment on an annual basis. That's best practice. The reason we recommend that is because that's the best way to make sure that you're meeting the criteria of those three bubbles that Celina talked about at the beginning of the presentation. If you're not on the right plan or you don't have the right loans, you want to know now so you can take action to remedy that rather than 10 years from now when you think that you're going to be getting your loan forgiveness. Now, you always certify employment retroactively. So, a really common question we get right around this moment in the presentation is, oh my goodness, I have employment from 2009 that I never certified before. That's cool. Do it now. Because again, you're always certifying employment retroactively and it never goes stale. But here's another reason to get in the habit of catching up if you haven't certified before and doing it on an annual basis. Your employer might not be keeping records for very long. It used to be businesses used to keep records forever, to use my Massachusetts accent. But now, if someone has a halfway decent information security program in legal department, they're being advised to trash records as soon as it makes sense to do so. So we have absolutely run into borrowers who were unable to, their old employer might still exist, but they're refusing to certify because they got rid of their records after 5 years or 7 years or whatever it is. Now, it's not impossible to still certify employment in that case. You can sometimes be successful by submitting W-2s from that period, but not always. The other thing that can happen is your employer might go out of business and then there is no records and there's no one to certify anything. So again, I strongly recommend that if you have past employment you've never certified, that you go ahead and do that and then be in the habit of doing it on an annual basis. And remember, nothing prior to 10107 counts. Nothing that you worked while you were in an in-school status counts. Um, Most periods of deferment and forbearance don't count, although now they are counting deferments, say if it's a cancer deferment, economic hardship deferment, any of the military deferments also count towards PSLF, assuming that you were meeting all the other criteria. And then there's limited forbearances that they are also counting towards PSLF, very limited forbearances. But otherwise, if you were in an in-school status, if you were in grace period or an in-school deferment, um, that's not going to count for PSLF. Now, the easiest way to certify your employment is with the PSLF help tool, which you can find at studentaid.gov, and we've posted the full link in front of you. Um, the help tool makes it happen all electronically, and the turnaround time these days is pretty decent. We still tell people 90 days to get an ECF processed, which stands for Employment Certification Form. But frankly, most of the time these days they're being processed a lot faster than that. Now, it used to also be that your loans had to be with a particular servicer if you were pursuing PSLF, most recently Mohila. That's not the case anymore. The Department of Education last year centralized PSLF processing and it's with an outside vendor. Um, so it doesn't matter who holds your loans anymore, as long as they're direct loans and eligible employment, eligible payment, et cetera, et cetera. So, if your loans were with Mohila and they moved, or maybe they're going to move in the future, or don't freak out about it because again, it doesn't matter who your loan servicer is anymore as far as being eligible for PSLF. Um, the servicers are the ones that report your status history to studentaid.gov. One thing to note is studentaid.gov is not real time. It only gets updated I think it's a couple times a month now that they update it. So your servicer might show an extra payment that FSA isn't showing and an extra month that FSA isn't showing, and that's okay. The only place to go for your PSLF counts now is studentaid.gov because, again, they centralized all the PSLF processing through the Department of Education itself via studentaid.gov. The Department of Education's vendor is the one that matches, a qualifying status qualifying payment plan with a qualifying month of employment. So they all the sort of data sort of merges together and matches or doesn't match within studentaid.gov. Um, and that's where you're going to track your eligibility and progress. You're going to submit your employment certification. You can even apply for an income-driven plan or consolidation through studentaid.gov. All right, I want to just sort of give an update or non-update about the SAVE litigation. So the SAVE plan was a really aggressive repayment plan that the Biden administration tried to implement to remove some of the economic burden from federal student loan borrowers. It was a very generous repayment plan, and unfortunately, 13 Republican attorneys general's offices filed a lawsuit saying that the Biden administration had exceeded their authority under the law for the plan. And the plan has been put on hold pretty much since then. And most of these borrowers, last I heard, around 8 million, were put in what's called the SAVE forbearance. Now, the SAVE forbearance in and of itself does not count towards PSLF. No payments are due, which is great, and no interest accrues during the SAVE forbearance, but it also doesn't count towards any type of loan forgiveness. Now, listen, SAVE is cooked. It is not coming back. I am 1,000% sure of that. The only question out there is who's going to put the headstone up? Is it going to be the courts or is it going to be Congress? We actually hope it's Congress. Remember when I told you that the House has spending marching orders to find 300 billion in savings under higher education? If you look at their current bill and the estimates, the cost saving estimates, more than 200,000 of what they're saving comes from killing the SAVE plan. So we want it to be Congress that gets credit for actually putting the final nail in the SAVE plan coffin. But again, SAVE is not coming back. You can't apply for it anymore. It's just sort of still in its limbo phase. In fact, you don't even see SAVE as an option on the most recent income-driven plan application. We do expect borrowers to stay in the SAVE forbearance at least until the fall of 2025. I personally think they might be stuck in that SAVE forbearance for longer, but at least till fall of 2025. Now, you have a choice. You can either ride out that forbearance and plan on using what's called buyback to get those months to count for PSLF, or you can switch plans now. And this is another question we get all day, every day. Should I switch out now, or should I plan on, ride out the safe forbearance as long as possible and plan on using buyback? And the answer is, I don't know. And the reason it's, I don't know, is because we're not sure what calculation they're going to use for buyback for those save months. If they're going to use the save calculation, which at this point I'm starting to think might be doubtful, then you should write out the save forbearance because that's going to be what costs you the least amount of money because your buyback amount is going to be less than probably what you would be paying if you switched to a new income driven plan. If they end up using for the save months a buyback calculation that's the equivalent of the next lowest income driven plan for you, then it's a wash whether you ride out the save forbearance or switch plans now. But if they use another calculation altogether, say the 10-year standard, then it's going to cost you more to do buyback than it would to switch plans now. And so buybacks were on hold for a while, but just in the last week, we're starting to see a bunch of borrowers actually get buyback offers. So those are up and running again. And it appears to me, and I'm not willing to put a pin in this yet, because I don't have enough even anecdotal data and I haven't been able to get an answer directly from the Department of Education yet. It appears that they're using the old repay calculation for the save months, in which case, again, it becomes a wash whether you switch plans now or whether you plan to use buyback. But again, I'm not certain enough to say with certainty that that's the calculation they're going to use for buyback. So you're going to have to sort of take the data that's available to you and make the decision that's best for you. Now, in my experience, a lot of PSLF borrowers are switching plans now because they just can't stand not to see their PSLF counts going up, and switching plans to a non-safe plan that's also a PSLF eligible plan is the way to start seeing your counts go up again. The save litigation has now normally with income driven plans, you're required to recertify your income on an annual basis. Although between the COVID pause and the save litigation, a lot of people haven't had to recertify in a long time. You will have to recertify again. The every 12 months thing is absolutely coming back. But because of the save litigation, a lot of borrowers, once again, had their recertification pushed out again. So most people won't have to do it at least before February of next year. All right, a little bit more about buyback. Buyback lets you really buy back, pay what you would have paid if you were in a status that doesn't count for PSLF, but if you'd known better or had a choice, I shouldn't say had a choice because there's some things you really just don't have a choice on. Um, you would have been on an income driven plan and making payments anyway. So let's say, say save forbearance, save an in-school deferment, for example, where if you'd known you would have gotten out of the deferment and gotten on an income driven plan, what you do is you submit this buyback request to the Department of Education or your servicer and say, listen, I want to buy back for PSLF purposes my months in the safe forbearance. And you have to submit proof of what your income was during this period. And they calculate what your payment would have been if you hadn't been in the safe forbearance, and they send you an offer. And you can either make that, pay that amount that they've offered you, at which point those months will count for PSLF, assuming it was an eligible loan and you had eligible employment at the time. Or you can decline the offer and just keep making your regular payments. Now, right now, you cannot apply for buyback until you have 120 eligible employment months certified. Now, the Department of Ed has sort of hinted around that they may get rid of the 120 requirement, meaning that you in the future you might be able to do buyback before you hit the 120. But as of right this second, you can't submit a buyback request, or you can, but it'll get denied until you already have the 120 certified employment months. The other tool you have in front of you, if something's squirrely on your account, is reconsideration. Now, let me be clear. Reconsideration is only if you think they made a mistake. Reconsideration, or buyback for that matter, are not if you don't agree with the rules. So, for example, um, let's say they denied your employer because it was a for-profit, and you don't agree with that. Your employer, you do work that's clearly anybody in their right mind would be considered public service work. Don't submit a reconsideration for that because for-profit employers never count other than that state law exception that I mentioned earlier. And filing a reconsideration is not going to change that. However, if you submit your employer and you think it is a qualifying employer under the law and it got denied, then you can submit a reconsideration request for that. If you think your payment count is wrong, so they didn't count months that you think they should have counted, and you think they should have counted under the law or under existing regulations, then you should submit a reconsideration request for that as well. But again, submitting a reconsideration request because you think it should count, even though the law or regulations don't support that, don't waste your time. Don't waste the Department of Ed or the servicer's time. It will not be approved. It will get denied. And, for the people that are going, well, I'm going to try anyway, again, please don't. The queues are really, really long for everything as it is. And reconsideration is never going to change a law or regulation. There are no exceptions to those. Um, any of you that are here, it's probably a good opportunity for you to take a look at your current loan status, your current PSLF count, and see if there's any actionable steps that you think you need to take right now. So for example, if you're in the safe forbearance, make the decision. Are you going to ride that out and plan on doing buyback, or are you going to switch plans now? Have you submitted your proof of employment lately? And if not, go over to that PSLF help tool and submit that proof of employment for all past periods. Um, Note that If you actually hit the 120 and get forgiveness, and it turns out you made more than the 120 required payments, they're going to automatically refund you, assuming that you hit the 120. They don't refund any payments pre-consolidation, but if you hit the 120 after you consolidate and then you actually made extra payments because you weren't sure if you were at the 120 yet, they will automatically refund you. Now, those refunds can take a minute. Um, it usually takes at least 60 days for the servicer to actually initiate the refund, which then goes to the U.S. Treasury, and the U.S. Treasury is the one who actually issues the check. And that can take up to 150 days. So between the time, so the servicer might take 60 days or more to initiate the refund. Um, if they haven't initiated the refund by 60 or 90 days, you should start calling and asking about it. The way to tell if they've initiated the refund is if you have a refund due, you're going to show a negative balance on your loan. If they've initiated the refund to Treasury, you'll show a zero balance on your loan. The negative balance will switch to a zero balance. And then once it hits Treasury, it can take up to 150 days. The bigger the refund, especially if you're in the thousands of dollars range, the longer it can take for a refund, the check to come from Treasury. I suspect that larger refunds have to go through some extra checks and balances before they're done. If now listen, Celina and I will be the first to tell you that things are chaotic right now, and we are seeing errors on accounts. And unfortunately, since the large layoff that was done back in February with the Department of Education, there's a lot fewer avenues, even for people like Celina and I, to get those errors fixed. Now, there are some things that I just wouldn't even bother filing a complaint on. And one of those things is if you applied for an income driven plan and it's been months and you haven't had it approved. That's because of the SAVE litigation. They had to pause processing applications for several months. And I know of people that have been waiting 9 months or more for their IDR application to be processed. Filing a complaint is not going to get that IDR application processed any further. We recently learned that there's almost 2 million pending applications. They are working through them, but the fact of the matter is no one borrower is more important than another, which is why filing a complaint to try to get your IDR plan processed is not effective. And again, just sort of muddies up the queue even further. But if there's other errors on your account, um, you absolutely, and you can, the first thing to do is call. Most errors can get sorted by making a phone call to your loan servicer. I actually prefer emailing the loan servicer. For some reason, I feel like the people that work the emails tend to have a little more power to get things done a little bit faster. And plus, there's a paper trail. So that should be your first step. But if it's still not resolved in a reasonable amount of time, and by reasonable, I mean at least 30 days, then you should file, you residents of California are really lucky. You have that great group, Celina's group that you can file complaints through. Uh, you could also file complaints through the Department of Ed Ombudsman Unit, although they took a really big hit with that layoff. My understanding is only one person in that office right now, but they are still accepting complaints. They're called feedback now, but they are still accepting complaints. You can also file a complaint through the Consumer Finance Protection Bureau. You can also write your member of Congress, House or Senate, and ask them for help. Here at TISLA, we also try to help people with disputes. But, again, the layoff really restricted the avenues that borrowers can use for escalation. As I mentioned, they get rid of a lot of the people in the ombudsman team. They get rid of both entire teams that did oversight of the loan servicers. And that used to be an avenue that we used to use to be able to get errors corrected. So, thankfully, a lower court said that that layoff was unlawful. I think it was last week. The Department of Ed was quick to appeal that. Um, but hopefully they end up bringing back a lot of those staff, whether they bring it back because the court makes them or whether they bring them back because they realize they really need them. They've already brought some of them back because they realized they really needed them. And hopefully that continues in the future. All right, before we talk about scams, I want to check in with my fine feathered friends sitting in our Q&A panel, Addison and Katie. Is there anything about PSLF or anything else I covered right now that you think I should talk more about?
There were a bunch of questions about what to do if months aren't showing up as payments.
Yeah, so we are seeing that there is a data issue, especially recent months. If you're talking about months like in the last 4 months or so, and the Department of Ed is aware of it. There's a lot of rumors online of how to, make those months kick in. Some people think if you like it, for example, if you're in the safe forbearance, if you make $1 payment, it'll make those months count. I think those are all myths. I just think that there is a operational issue that might or might not be related to the save litigation, um, where the servicers might not have been updating the months. Now, what I saw, I looked at a couple borrowers' accounts that sent me details on their accounts for May, and it looks like they were reporting in May. They may start catching up. Now, if the months you're missing are not recent, they're from a while ago, first of all, make sure you filed your proof of employment. And then the next thing to do is use that reconsideration tool that I mentioned before. What else, Addison or Katie?
Now, we've also got one pending question that I wasn't sure about. I guess you mentioned something about loan servicers controlling status history, and a borrower wanted clarification on that.
So the studentaid.gov site is not real time. They get their data from outside vendors, including the servicers. So let's say you get put in an in-school deferment. The servicer is the one who's going to process that deferment because your servicer is the real-time account. And then during their normal monthly reporting cycle to the Department of Ed, they will then report that in-school deferment to the Department of Ed. If you come out of a deferment and now you're in a repayment status, same thing. It's the servicer that's going to process that. So let's say the servicer processed it today. And so, like yesterday, you were in an in-school deferment. Today, you're in a repayment status. That's not going to show up on your studentaid.gov account for at least a couple weeks, most likely, depending on where they are in the reporting cycle. So, again, your servicer account is real time. They're the ones that do the everyday processing of the things. Studentaid.gov is sort of the receiver of the data from the servicers and the PSLF vendor and so on.
Betsy, we did have some questions about for those that already reached the 120, like and it's showing that their payment is due. So there is a little bit of a time gap from the time that you'll see the 120 on your studentaid.gov and then the time the actual discharge goes through. So you may see it on one end and not the other. So what a borrower can do is in that case, you can continue making the payments, and then if you may make any payments over 120, request then you'll receive the refund. Or you can contact, if you're sure that you're at the 120, everything's clear on studentaid.gov, you can contact your servicer and get on a forbearance until they process the discharge. So you can do either or, but it won't be immediate. You're gonna have to wait a few weeks, possibly a month or two, probably not that long, but you will see it eventually catch up. But your final, when you know you're at the 120 is your balance is zero, your credit report, it should be updated. That will take a little bit longer, but those are your two options.
Yeah. Thank you, Celina.
You're welcome.
We do want to warn you to watch out for scams. There are a lot of them out there. The Federal Trade Commission is doing a great job going after the scammers, but it's like whack-a-mole. They bring one down and another one pops up. There is zero reason to pay anybody to help you with PSLF or your student loans in general. They can't do anything for you that you can't do yourself for free. And if you have questions, there's tons of information online. You can come to us here at TISLA. You can go to Celina with questions. Paying somebody to help you with PSLF or anything else with your student loans um, is it's not going to get you forgiveness any faster. It's not going to qualify you for a program that you wouldn't normally qualify for. And a lot of them they're not all scam. Paying somebody to help with their student loans doesn't automatically mean that company's a scam, but a lot of them are, especially if they promise you forgiveness up front. We also see scams where they say that they partner with the Department of Education, or we've even seen some where the name of the company is like one letter off, or one phone number off, or one website letter off from a legit loan servicer or the Department of Ed. So if you get a call or a text or a letter from someone claiming to be working with the Department of Ed or your servicer and you're not sure, hang up or delete or do whatever and literally go and find your actual servicer website and contact them through the contact information on that website. Um, no legit uh, participant in the loan programs is ever going to ask you for a fee, and they're never going to ask for your login information. It's actually against the law for them to do so. So that's another like enormous red flag if someone asks you for your login information. And these companies are squirrely. They might have your student loan information. I think they scrape credit bureau reports somehow to get that and so on. So they can be squirrely buggers. So again, when in doubt, just disengage and go to your actual servicer's website or studentaid.gov and contact through that avenue. Um, that's all I had. Um, we do have a few more minutes if there's other questions that. So there's one right now that just popped up. What's the difference between PSLF and IDR? They're completely different programs. Public service loan forgiveness is the program that we've been talking about, where if you make 120 qualifying payments while working eligible employment, they forgive the balance of your loan. IDR is an income-driven repayment plan. So that's a plan that adjusts your monthly payment amount based on your income. Now, the IDR plans have forgiveness components baked into them as well that are unrelated to your employment, and you usually have to be on them for 20 or 25 years. And actually, some of those programs, the forgiveness is at risk because of this darn save litigation. Um, but they're completely separate programs. Most people do need to be on an income driven plan to really benefit from PSLF. Someone asked, and I sort of just alluded to this, is IDR forgiveness gone? No, as of right now, the forgiveness under specifically income-based repayment is safe. Whether forgiveness still exists for pay-as-you-earn and income contingent repayment, that remains to be seen. We've never had anything like this happen before, anything remote, and I've researched higher ed policy back to the 70s, like we're seeing with the SAVE litigation. So it's really unclear what's going to happen with the forgiveness component of ICR and pay as you earn. And just to be crystal clear, again, that forgiveness is completely unrelated to the forgiveness for PSLF. I'm talking about the 2025 year forgiveness for the income driven plans.
Hey, Betsy, quick question. We have
Yo,
such good resources. How can people get clickable links that we're providing? Is that possible? I know it's going to be on YouTube, but what can they do?
I mean, the two basic things you should, I mean, I don't know, Katie, if you want to try to, let's see how fast you can type and throw those up in the Q&A so people can copy and paste. But really, the only two you need are studentaid.gov and freestudentloanadvice.org. If you bookmark those, both of those sites, I would like to think are easy enough to navigate that you should be able to find the longer links that we've mentioned along the way. Maybe irs.gov, if you wanted to, look at the 501c3 database or find information about married filing separately. But those are really the only two that you need.
And for some reason, Betsy, we are not able to enter, Katie and I aren't able to enter links. So I've been trying to do that the entire time. But anyway, there was a question, there's been some about buyback. If we could just do a like over quick high level overview of buyback.
Okay.
Do you want to, I think that graph or that just depicts it perfectly. You have to be at the 120. You have to have certain months where you were in forbearance. where no payments were made, and you can go back once you're at the 120, you can go back and purchase those months. They basically write up the Department of Education writes up an agreement, looks at what your payment was the months before and after, and they'll send it to you and say, if you pay back, you can pay back this amount and basically buy back March, April, May, or whatever the months are. That would get you to your 120. So you have 120 months of employment, and for some reason, whether it was a transfer, maybe there was you requested forbearance for some reason, or there was a transfer of your loans, but you have some missing months, you can go back and purchase those months to get you to the 120. That's a high level overview of that program. But I think this graph right here, or this little drawing, depicts it perfectly.
People are asking, I submitted an application for a plan other than SAVE, another income-driven plan. How much do I know how I'll have to pay? If you're in the SAVE forbearance, you're not going to be due anything until they process your new income-driven plan application. If you're not sure what your new IDR payment's going to be, you can use that loan simulator tool. One thing I want to mention, studentaid.gov, on the loan simulator tool and sometimes on the PSLF page, there's this message that I find incredibly annoying that says some of your loans aren't eligible for PSLF, or some of your loans aren't eligible for this IDR plan unless you consolidate. That's usually nonsense. It sometimes that message comes up because it's maybe you consolidated FEL loans in the past, and even though those loans are showing zero, it's still picking up on those. Um, it could be because you're in an in-school status or grace, and you can't apply for an income-driven plan until you're out of that status. So most people should be able to ignore that message. If you're not sure, call your loan servicer to double check. But that messaging sort of freaks a lot of people out. I wish they would get rid of it. What can employers do to help their employees pursuing PSLF? I love that question. I love that question. So I don't understand why more employers don't recognize that PSLF is a free benefit. It can be an incredibly powerful recruitment and retainment tool. We talk to borrowers all the time that say, "Oh, I'm absolutely staying at my current employer at least until I reach PSLF," which was one of the sort of points of the program when Congress created it, or I'm actively looking for a PSLF eligible job. You know, we work with a lot of employers that do try to do some extra hand holding with their employees. They do promotion of PSLF. They offer at least annual PSLF trainings. Here at TISLA, we actually have a program specifically for employers called PSLF Peace of Mind, where we help employers use PSLF as the benefit that it is. And I know it might seem I planted that question. I swear I did not plant that question. Um, but if people didn't want to use a program like that, it could be as simple as offering annual PSLF training, doing frequent communications to their employees, just even if it's just pointing them to studentaid.gov, the PSLF page. Those are all free resources for borrowers, or the PSLF page on Celina's website, or the PSLF page on our website. Again, all completely free resources.
And one thing that we do here at our agency, and that's really helpful, is having a PSLF contact person in HR, personnel, just sending out an email saying, send the ECFs to this email, because you do need an email to when you're doing your form. So just having a designated staff, HR staff, that can answer questions and sign those forms so they don't get lost in spam and limbo. And yeah, that's super helpful.
Yeah, so on a related note, I love to see when employers, whoever's signing the form gets put through some like additional training, so they're sort of the on the ground PSLF experts, so they can answer a lot of questions for the employees as well. Um, and it really does help. I mean, I don't understand why every single PSLF eligible employer is not putting the fact that they're PSLF eligible in their job postings. as well. It seems like a really and a lost opportunity. All right, it looks like the questions are slowing down. Um, so I'm going to stop the recording.
Yeah, so it looks like we're almost at time. Thank you for every